Okay, so it's now it's 1 GMT, 3 o'clock. 3 o'clock here in Barcelona, also in Brussels, and 4 p.m. in Athens. I'm going to talk about the state of euro dollar amid the Greek default and the NFP. Sorry for the typo. I'll take questions at the end in the chat room. I already see one question, but I'm going to talk about everything at the end. It's going to be about 45 minutes, 30 minutes of my presentation, and then 50 minutes of Q&A, more or less. All right, so let's start. About myself, my name is Yohay Elam. I used to be a retail trader and a computer programmer. I founded Forex Crunch back in 2008. The focus of the website is fundamental analysis, the big things that move markets. And I also touch on technical analysis for entry, exit points, breakouts, and things like that. Okay, what will we cover today? So, the current state of euro dollar, an update on Greece, the euro's behavior on Greece, which was quite strange at times, especially on Monday. Then we'll move to the United States, talk about the state of the Fed, and do a non-farm payrolls preview this week. It's on Thursday, it's tomorrow, because of the 4th of July holiday. Then we'll have a Q&A session. Now, please put all your questions in the box called chat, not in any other box. I will read only the ones in the chat box. Okay, so let's start. So this is how euro dollar is looking in recent days. It rallied from the lows it has seen a few months ago. It reached a high of 114.60, then fell again to 108.20, then rose again to another high, and then you can see this weird candle. That's Monday, where we had euro dollar begin quite low and then close the gap and even rally higher. The lines I'm watching, we have here all the lines on the screen, but for the shorter term, it's 112.90 on the top side, 110 on the downside, then 108.20. These are sort of the most important lines on euro dollar, the world's most popular currency pair. So, but if we look at the bigger picture, not only the one in the last 2-3 months, if we look 1 year back, it was 140, 138, something like that. We had a big fall. Now we have some kind of recovery, and we still don't know if it's a real recovery or just a correction. Currently, we're seeing relatively narrower ranges than earlier in the year. Okay, so the bigger picture is a fall even at 114.60, a fall of around 2,600 pips over a year, which is quite a lot after many years of, or a long period of low volatility. All right, why is the euro going down? Basically, monetary policy divergence. The ECB, President Mario Draghi, with the glasses here, he cut interest rates, including a negative deposit rate, and is now printing euros, buying bonds, while Janet Yellen, the chair of the Federal Reserve, she ended QE back in October, and the Fed is set to raise the rates probably in September. That's the main reason for why euro dollar is falling. But of course, there are many more movements in the shorter term. In general, regarding the future, the ECB is not set to raise the rates until late 2016, and probably keen on implementing QE up to September 2016. And the Fed is, yeah, okay. Greece, okay, that's the main, it captures headlines all over the world. It's a really big story for the Eurozone because once one country gets out, I think the door is open for more countries. Let's see what happened in recent days. I mean, the recent escalation. Negotiations were going on for about 5 months since the recent recent elections, when the Syriza left party captured captured power through elections in Greece. Negotiations have been going on for a while, but Greece got a final offer on Friday. It was sort of a take it or leave it, even though some European officials denied. Greece rejected the offer. Greek Prime Minister Alexis Tsipras went back to Athens and announced a referendum after markets closed on Friday. On Saturday morning, Saturday at noon, here in Europe, the Eurogroup, group of finance ministers of the Eurozone, did not approve a short bailout extension. Greece asked for another week or two just to hold a referendum. In addition, on Sunday, the ECB capped the ELA. European Central Bank is supporting giving a lifeline to Greek banks via the ELA, Emergency Liquidity Assistance. Now, when we had people withdrawing money out of banks in Greece in recent weeks, each time the ECB raised the amount of money it lends to Greek banks, on Sunday decided not to raise it. And as withdrawals were quite intensive on Saturday and Sunday, Greece announced on Sunday evening capital controls and the shutdown of banks. So banks are closed since Monday. Now we're already on Wednesday. Withdrawals are limited to only 60 euros per day. It's about $66, $67. And for pensioners, it's double 120 euros. Protests are held on a daily basis in Greece towards the referendum on Sunday. Greeks in general are worried. Some blame the government for mishandling the situation. Some blame the creditors. So what's at stake is the proposal made on Friday, which still hurts pensions and raises the VAT and doesn't include debt restructuring. Greeks are expected to vote yes or no on Sunday. Many European leaders described it as a vote on the euro or the drachma, the previous currency, on a Grexit or not. Now, in theory, there is no provision in the Euro Treaty that allows any country to kick any other country out of the Eurozone. It's like Hotel California, as was described. You can check out, but you can never leave. On the other hand, if Greek banks collapse and there's no money, Greece will have to introduce a parallel currency. It means it will be forced out, practically. Even if there's nothing official, basically, if you don't have any euros, you need another currency. What happened on Sunday? So first of all, we had a clear reaction in peripheral bonds. Spain, Italy, bond yields went up, stocks plunged all across the continent, in London and Germany, in France. That was sort of the expected reaction. Also, Eurodollar began with a normal reaction. It gapped down from 111.60 all the way to 110, and then it fell as low as 109.50. But then later on Monday, it rallied all the way up, not only closing the gap, but even reaching 112.75, just under the 112.90 resistance line. So why did this happen? Well, I listed on Forex Crunch 5 reasons. Let's go over them. So first of all, since the ECB has the negative deposit rate and QE, it's basically printing euros. The euro is used as a funding currency. People, banks, investors lend money in euros and spend it elsewhere. That's one of the reasons the euro, of course, weakened. And then when there's times of trouble, this money is repatriated back to Germany, back to France, back to the original countries. It's the same phenomenon which happens with the yen. And that's the... so I can't say it's a safe haven currency, but it does as a funding currency, it does react in mysterious ways. When there's bad news, money goes back to Germany. Secondly, the Swiss SNB shocked markets in January when it ended the cap, ended the floor of 120 under Euro Swiss, and brokers went crazy, markets went crazy. But it doesn't mean the Swiss National Bank stops intervening. It does want a weaker Swiss franc, so it bought Euro Swiss. When it buys the euro goes up. Third topic is, of course, the yen safe haven. The yen also strengthens in times of trouble, also funding currency and even more safe haven currency. So it wasn't exactly the dollar that enjoyed that panic in the markets, but more the yen. So that's another reason why Eurodollar could recover. In addition, at least on Monday morning, there were hopes for a deal. Quite a few European officials still talked about a deal that could happen before the deadline, after the deadline. So this new hope, even after banks were closed in Greece, also allowed the euro to recover. And the interesting impact on the Fed. Now, the Fed is expected to raise rates in September. The situation in the United States is improving. We'll talk about that later. But if Greece leaves the Eurozone and there's trouble in Europe and trouble in China and trouble all over the world, maybe the Fed, which is quite dovish, will refrain from a rate hike, will not raise the rates so fast, will continue supporting the US economy in this global storm. So then there's no reason to buy US dollars. So all these 5 reasons altogether did support the euro. That's why we're not seeing very straightforward reactions in euro dollar. If you want to stay away from euro dollar, and want to trade sort of the risk on, risk off, you could go to Aussie against the yen. I talked about that with Dale Pinkert of FX Street's excellent live analysis room. The Australian dollar is a risk currency, and the yen is sort of the risk off. So if there's good news, we see Aussie strengthen against the yen, and on bad news, we see the other way around, the yen strengthening against the Aussie. But let's go back to Europe. Now the deadline is already behind us. Today is July 1st. The deadline was June 30th. It was a double deadline. It was a deadline for Greece to pay the IMF, around 1.5, 1.6 billion euros. Greece announced it would not pay. It did not pay. IMF announced the payment wasn't made. Officially, this isn't a default, although it looks like a default, smells like one. It's only arrears. It's only temporary delay of payment. But it's quite unprecedented for a developed country not to pay the IMF on time. Also, the bailout, the second bailout that Greece received and was expired. Greece yesterday asked for a 2-year ESM bailout without the IMF that it hates, but it did ask for debt restructuring. The EU so far refuses to talk before the referendum, but that's also a bit more complicated. I updated this slide just before we began the webinar. Here are the upcoming developments for today. The Eurogroup meets at 3:30 GMT. That's in about 2 hours' time. Currently, there's a referendum on Sunday that might be cancelled, but currently there's a referendum called also referendum. That's the hashtag on Twitter. Merkel, the Chancellor of Germany, said she's ready to talk only after the referendum, while French President François Hollande was ready to talk already now. Tsipras, the Greek Prime Minister, is set to address the nation anytime, maybe already now, maybe in an hour or two. Things are moving quite fast, and I'm not sure when exactly this will happen. The base case scenario that I stick to, even though the situation is quite dangerous at the moment, is that nobody wants a Grexit and Greece will eventually stay in the Eurozone. Greece needs to feel part of the Eurozone, needs to feel part of Europe, needs to feel part of democracy. Even though switching to an independent currency can help with exports, with tourism, the transition will be too painful. It's not that Greece has its own currency and it's just locked in a monetary fixed exchange rate mechanism to other currencies. It just doesn't have another currency, and it'll just cause chaos. In addition, Germany needs weaker economies in the Eurozone to weaken the euro. Germany is dependent on exports, and it does enjoy a weaker euro. Its trade balance is high thanks to a weaker euro. Otherwise, it would be with higher unemployment. So that's the German interest. In addition, the Eurozone so far has been irreversible. Means, as we said, Hotel California, nobody leaves the Eurozone. Once one country leaves, the doors open for other countries to leave. It may not happen now. It could take a year or two, but contagion can always happen. Just a reminder, with the big financial crisis in 2008, it began with the subprime crisis in the summer of 2007. And a few months later, everybody said, that was just a small crisis and it's over now. But then we had Bear Stearns, Northern Rock, and eventually Lehman Brothers. It took over a year for the whole system to explode. So even if we hear statements like the Eurozone is ring-fenced, Greece's economy is only 2% of the Eurozone and things like that, once one country leaves, the doors open. So I think nobody wants a Grexit, and eventually we will find some kind of some kind of a deal. But things are moving fast. Watch the headlines. The big event is the Greek referendum, assuming that it does happen on Sunday. It'll be an interesting open to the markets again on Monday. Okay. Now moving to the United States, crossing the Atlantic. What's going on with the Fed? Okay. In the June meeting, we had no forward guidance. A rate hike can come at any time. The Fed does acknowledge the weakness in Q1, but was generally upbeat about the economy. Good rise in jobs afterwards, more growth in the spring. However, the dot plot is that was published in June suggests a hike in September, but we're not sure if we'll have another hike in December. The market is still fixated about the timing of the first rate hike, but is also beginning to look forward to the second rate hike, to the pace of the rate hikes, to the final level of interest rates. And many suspect that Yellen sees only one rate hike this year, and Yellen has the final word eventually, even though we have many members of the FOMC, 10 voting members, 17 in total. But Yellen is usually dovish, and we assume that she doesn't want a rate hike that fast. Only one. So the Fed remains in general data dependent. That means it's watching all the data, and of course the non-farm payrolls is important. Next meeting is only in late July, but without forecast, without a press conference. That means it's probably going to be a non-event. Of course, the markets are going to move on every word in the statement, but the real focus is on September. There's lots of data until then, until September. Every non-farm payrolls release is critical. I think September, we have many hints about that. I think it's going to come. But of course, nothing is certain. As I mentioned before, if Greece deteriorates, that means that if Greece deteriorates, the Fed could perhaps refrain from rate hike. But Yellen said many times that rate hike is coming in 2015. So the current state of play regarding non-farm payrolls and rate hike is, if the non-farm payrolls is not a disaster, a rate hike in September is on the cards. If the NFP is amazing, above 300,000, 400, I don't know, there's a chance of a second rate hike in September, and the markets will begin pricing it, and that will be supportive of the dollar. If the data is less than okay, maybe rate hike expectations will be pushed back to December, and that, of course, would be dollar negative. So U.S. hikes. The timing of the first rate hike still has a big impact on the U.S. dollar. This matters even though the balance sheet of the Fed remains large. It's important to remember the Fed did end QE in October, but didn't squeeze its balance sheet. It still has $4.5 trillion on its huge balance sheet. So, and in any case, the Fed made it clear, and the markets are beginning to understand that the pace of rate hikes will be gradual. So after the first rate hike, it could be a different story. But for now, the markets are still, even though they're beginning to understand, what matters for them is the timing of the first rate hike. And now it's priced into September. Let's talk about the recent US data. So, of course, we know that the first quarter was bad. We had a squeeze of 0.2 in the economy. That's annualized, so actually it's not such a big squeeze quarter on quarter. The Fed blamed it on bad weather, on strikes at ports, things like that. But recent data is better. We had durable goods orders rebounding. It was quite worrying when investment was quite weak. That's the core durable goods orders. Manufacturing PMIs rebounding from the lows. We had this week consumer confidence, and also last week. This week we had the CB, Conference Board Consumer Confidence, and it's above 100. The University of Michigan's one was also revised to the upside. And perhaps also interesting for the Federal Reserve, housing is back on track. We had last week releases of new and existing home sales. They both beat expectations, and because there's just a very, very good correlation between the housing state of the housing sector and the general economy. Of course, we've seen that with the boom and the bust of the 2000s. When we had the boom, the US economy was doing well, and when the music stopped in housing, we had a crash in the full economy and, well, eventually in the global economy. So we're seeing housing back on track, but without, at least as far as I know, without any bubbles this time, at least not yet, at least in most regions, okay? Regarding inflation, the Fed has two mandates, that's inflation and employment. Inflation is quite solid. The Fed focuses on core inflation, that's annualized 1.7%. We had in recent weeks good jobless claims figures. It's published every Thursday, around 270,000. That's relatively low. That means that jobs are created and there are less people who are unemployed. There is some kind of correlation between the jobless claims figure in the second week of the month and non-farm payrolls, although it's not always that clear, but it's been very, very stable during June, and that's, of course, encouraging. There's been some improvement in the employment cost index. It's another measure of wages. And all in all, the situation is okay on inflation and okay in jobs, and these are the Fed's mandates. Let's move to the non-farm payrolls, tomorrow's big event, this time on Thursday, starting with last month's figure. That was the figure for May. So we had an excellent headline number, 280,000. We had general revisions of 32,000. Unemployment rate 5.5. That was stable, but I don't look too much at the unemployment rate because it depends a lot on the participation rate. Participation rate is still low. It means the number of people who participate in the workforce. So if we have a low unemployment rate but hardly any people participating, it's not really good. The low that we reached in the participation rate was 62.7. It's still not convincing, but 62.9 is at least above the lows. What was, apart from the big growth in jobs, was the big growth in wages. Okay, we have the employment cost index, the unit labor costs, things like that. But the most important thing is what's called average earnings in the non-farm payrolls report. That rose by 0.3%, better than expected for May. And the annual wage growth, even more importantly, was 2.3%, finally breaking up out of range. The real unemployment rate, the U6, which also counts discouraged people, remained at 10.8%. That's sort of a reality check. But anyway, the situation is improving on job gains and on wages. So what are we expecting now? Official expectations stand at around a gain of 230,000 jobs in June. We just had ADP around an hour ago. It came out at 237,000 in the private sector. That's better than expected. Just after this webinar ends, we have the ISM manufacturing PMI. Because it's Thursday and early in the month, we don't have the ISM non-manufacturing PMI. That means we don't have the indicator for the services sector, which is the biggest in the United States. So expectations are a bit wilder. I think that thanks to the ADP, maybe expectations are just a bit above 230, maybe 240. Unemployment rate is expected to drop to 5.4%, and which is more ambitious, but more importantly, expectations for the average hourly earnings stand at a monthly rise of 0.2%, less than 0.3% last month. And I think that's critical because expectations are relatively low, or medium, not very ambitious. And if we have a beat on wages, it could be quite positive. So first of all, a headline number, the change in jobs. If we have above 280,000, it's positive for the dollar, no matter what. It's just a good number, even better than last month, strong in general, and could raise the expectations for a rate hike a second rate hike in December, and would strengthen, of course, the chances of the first rate hike in September. If it's, on the other hand, under 200,000, it's of course negative for the dollar. It means that the recovery in the spring is not as strong as expected. The Fed might have second thoughts, and well, the dollar could fall across the board. If it's in between, it depends a lot on the wages. So the average hourly earnings, why is that important? Because when people find jobs, big question is, okay, we have a low unemployment rate, but is that good enough? Where's the inflation? Usually when there's higher employment, we see more inflation. But if wages are not rising, where will inflation come from, especially as oil prices are falling? So wage inflation, that's the source of core inflation. It's finally moving up. I think if we get an annual rate of 2.5%, it'll be very dollar positive. I think there is a chance of that. It'll be surprising for the markets, but of course there is a chance, but probably small. Wages rise relatively slowly. There's a gap between GDP recovery and jobs recovery and wages recovery and wages. The move, there is always a lag. It takes between 6 months to 12 months, and some say 18 months between all these stages. Usually wages rise quite slowly, only when people change jobs or around the end of the year. We didn't see a big rise in wages early in the year, but we're beginning to see it now, and hopefully it will accelerate. So conclusion, non-farm payrolls above 280,000, that's dollar positive no matter what. Under 200,000, it's negative. In between, depends on average hourly earnings. I think if it's above 2.3, it's positive, even 2.5. If it's 2% or below, it's of course negative. In general, wages are becoming almost as important, almost as critical as jobs. Jobs still take first place, but wages are not that far behind. But of course, what's next for euro dollar in the short term? The NFP could help the US dollar against the euro. Of course, if we have a terrible figure, it'll be bad for the dollar. But with the potential Greek rupture, a Greek exit, or the crisis in Greece in general, a rate hike could be pushed back. So we have to watch the NFP, but we have to keep an eye on Greece as well. In general, we have interesting times with high volatility. High volatility means more opportunities, but also more risks. Please don't trade with extremely high leverage. And another thing a general thing regarding the non-farm payrolls, nobody knows what it's going to be. Of course, there are expectations, and expectations drive the reaction. But by taking a position before the figure is released, you're basically betting on the number. So I think it's better to wait for the number, let markets settle, and wait for the long-term reaction. Sometimes the first reaction is not the strongest one. So just be careful out there. All right. So in general, for the longer term for euro dollar, I think we have a chance to see new lows relatively soon before we see a comeback later in the year. Currently, we have expectations for the Fed to hike. That's keeping the dollar bid, and that'll boost the dollar. But after the first rate hike, we could have some kind of buy the rumor, sell the fact, and euro dollar could start a recovery. That could happen late in the year. So that's my long-term outlook. But in the short term, we have lots of choppiness. Yeah. Okay, that's what I've prepared for you today. I'm ready for questions, especially, and don't forget, put the questions in the chat box. I already see the question from the beginning of the session. How do we predict NFP is going up or down? Well, the expectations for the non-farm payrolls are built according to figures released during the month. And that's jobless claims, various consumer confidence figures. We usually have a long buildup with ADP, which we got today, manufacturing PMI, which we'll get in a few more minutes. And usually we have also the non-manufacturing PMI. We don't have it this time. And we have economists' expectations, which are published by Bloomberg, Reuters, and then FX Street and other websites. And that's what creates the expectations. How about impact on stocks? What, NFP? Currently, it's still a normal reaction. That means if we have a good number, it's good for the US economy, good for stocks. And the negative number is bad for stocks. In the past, often we've seen a different reaction, meaning good number means the Fed is going to tighten. That means interest rates are going up. It's bad for stocks, and sort of the counterintuitive. But I think now we have the normal reactions. I think the US dollar will strengthen in the short term against the euro because of what's going on in Europe and because the Fed is set to tighten. And the divergence between central banks. That means euro dollar, I think it will go down. That's my observation, that's my thought, but of course nobody knows the future. And I think that towards the end of the year we might see it reverse. That means euro dollar going back up. More questions? Yeah, question short term, do you mean going into August will USD strengthen? I think so. Assuming there is no Grexit, of course, that make markets very, very messy. Short term also, very short term, USD strengthening, but it might delay the rate hike. But assuming there is some kind of can-kicking exercise in Europe, in general, the Fed is tightening, the ECB is loosening. So I believe that we'll see this is the main thing at play, and that will strengthen the US dollar against the euro. Yeah. Remember that August, you asked about August, that's a month when volatility is relatively low. When liquidity is relatively low, that means action is a bit wild, and markets will come into full play in September. July still has high liquidity. Cable recovering against the US dollar. Well, regarding cable, it's important to remember, contrary to what many Brits say, the UK is still in Europe, not in the Eurozone, but in Europe. And if we have trouble in the Eurozone, it affects the UK as well. Assuming things stabilize in the Eurozone, the situation in the UK is better than in the Eurozone, and the Bank of England is also set to raise rates sometime. And we've seen a strong pound dollar. So if things stabilize, I think euro dollar could slide, but pound dollar could stay stable or even rise because of rate hike expectations also in the UK. You're welcome. Okay, while we wait for more questions, let me move to the next slide, which is a thank you slide as well. Thank you, FX Street, for hosting the webinar as always. You're welcome to visit Forex Crunch. And we have a podcast in which, of course, every week, Leorcoin and I, Leorcoin of Trading Energy and myself, talk about markets. The recent one is about Nonfarm payrolls and about the Greek crisis. That was recorded before the weekend's events, but I think the information is still relevant. The recent episode, here are some contact details. There are applications for Android and iOS. Thank you for the kind words. More questions? We have quite a few more minutes. Want to talk about levels, have questions about the Aussie dollar, about like anything else Forex related? Did anybody see any change in spreads because of the situation in Greece on euro-dollar, because some brokers warned about it. I think eventually it didn't happen, but maybe you guys experienced something I haven't heard of. JPY. Yeah, I mean, JPY has just a risk-on, risk-off thing. I mean, you have to trade with care because there are lots of pips there and the action is quite wild. But basically, if you have bad news, it's going to fall, and if you have good news, it's going to rise. So it's quite straightforward, but trade with small amounts because the amount of pips is high. It's very sensitive to news, and it stays away from euro-dollar, which has other moving parts. Referendum. Do I think it will go ahead? I think it will, because that's what voters are expecting in Greece. But I don't know. I think that some people in the European Union are a bit afraid of democracy, and they prefer to cut a deal than test it with the voters. When Greece went to elections in 2012, it resulted in a hung parliament, and they had to go on to elections once again, and caused more economic turmoil. Now, when they went to elections once again, for quite a few European leaders, the wrong party was voted in. So maybe we'll have some deal that will prevent a referendum. Things are moving so fast, so in the past hour, I'm sure there were lots of headlines. Past half an hour. US 30 cash. What do you mean by US 30 cash? If we're talking about long-term mortgage rates, I think they'll begin moving quite fast once the Fed raises rates. I think many in the markets don't believe the Fed is ever going to raise rates, but once they do it, and even if they promise not to raise rates too fast and too soon and whatever, I think 30-year yields will begin moving, getting ahead of the next Fed hikes and begin moving fast. See if I can pick the latest headlines for Greece, from Greece. Well, I see some headlines here from Italy, Italian officials saying that the Eurogroup is willing to avoid a Greek exit from the Euro. Okay. Another headline is about Tsipras Greek Prime Minister is about to talk to the people, but he might wait until the ECB decides on the ELA. All right, next question. Okay. Do you feel the general movement of GBP pound euro will be bullish or bearish? I think the general direction of is for a stronger pound and a weaker euro because of the different economic cycles the economies are in. UK is doing better than the Eurozone, no matter what. So I think any question is a good question. No worries. So I think we had a dip under 70 cents this week in euro pound. That's the convention I'm looking at, and I think it could go even lower, but it's a very gradual process. If we talked beforehand about Aussie yen, which has lots of pips, then euro pound is moving more slowly, but I think we have a clear direction. You're all welcome. Ready for more questions? We have, I think, 5 more minutes or so. Yeah, some doubt that we'll really have a referendum, not only you guys. I'm not sure I understand this last question. You tell me data meeting. Well, if we have a good non-farm payrolls, it'll be good for the US dollar, 280,000 or higher. If we have under 200,000, I believe the US dollar will weaken. It's a special non-farm payrolls report. It's published this time on Thursday. Markets do remain open, but with thin liquidity on Friday. It means markets will have more time to react, but things could be wild. So it's a special publication in this sense. All right. Any recommended positions for a day trader? No, I don't provide any signals. I'll just say that euro-dollar trading is a bit more complicated because of the huge influx of headlines regarding Greece just all the time. 3:30 GMT will have Eurogroup meeting and at unknown time today an ECB meeting and then an address from Alexis Tsipras. We're one day after the deadline, of course. Yes, the Eurogroup meeting is 3:30 GMT. That's 5:30 in Brussels, or here in Barcelona. But it was postponed from the morning. Yeah, things also are quite flexible. The ECB meeting, I think it is at 4 Brussels time, 2 p.m. GMT, but I'm really not sure. And it's unknown when we'll get the headlines. There's also uncertainty about the timing of speech by Tsipras to the nation. And there was talk about this address already at noon, already 3 hours ago, let's say, and it still hasn't happened. In the meantime, we've heard from German Chancellor and French President. In the meantime, at 2 p.m. GMT, we have the ISM manufacturing PMI, which also has an impact on markets, of course. Indeed, it could be quite a ride this afternoon in Europe during the mix of towards the end of the European session and in the middle of the US session. And also tomorrow is a full day with non-farm payrolls. Negotiations around Greece are almost 24 hours a day. Of course, mostly during the European day and less during the night, but No, thank you very much, you guys. Okay, I think we've reached the end. There's no last question. I'll thank FX Street once again. You're welcome to visit Forex Crunch. Help you organize your thoughts about Greek crisis and non-farm payrolls and trade safely, as mentioned here. The webinar is recorded, so if you missed anything, you can just watch it. Thank you very much, and see you soon. Safe trading. Bye-bye.